I just clicked on go live. Okay. Hi Zach. Thank you so much for coming on to Venture with Grace today.
Great to see you.
Awesome. Okay, so to give the audience a little bit of your background, so I have probably stalked all of your other podcasts from like the full ratchet era to like literally now. So from my understanding, so you have gone through a couple stages. You were an entrepreneur for like 20 years, and then your original product was basically you were job hunting in San Francisco, and then you met like a bunch, like you were like networking in these like hot events, and then you were telling people instead of like telling people you're looking for a job, you're like, I have this ad tech company idea. And then someone decided to fund you. And then you called your sister who are like living in Brazil. And then your sister came to kind of like work on this company with you. And then you guys were doing amazing. You guys landed clients with like, helping them generate like millions of dollars. And then Facebook copied your product. Um, and then the rest is history. And then throughout this time, you're playing poker with a bunch of entrepreneurs from like the Uber founder to Airbnb founder to like literally every other successful entrepreneurs. And then at this point, you basically you're like advising for there are like a couple of the company that you talked about. One is like Hellosign. It's like one of your ex-wife's friends who are like starting a company. You kind of like help them to move to the Bay Area, all that. And then the other company is like, I think Branch Metrics, and like NEA was about to invest in them for, and then you signed up Angelus and got like 100K or like 200K allocation, and then you kind of fill that up within like just like days. And anyway, so this is the TLDR of like your angel investing journey. I also pulled up your Excel sheet of exactly like, what you invested. I feel like a complete stalker. Anyway, and then you have like the fund journey started. You so you have like a blend pool capital since like you are like, well, you were raising on Angelus in 2017 to 2018. It was like a $1 million angel fund, and then it
Yeah.
invests in Mercury and some other companies. And in 2019, you have a fund with Industry Venture. So Industry Venture invests in funds, and then you and then there's like a basically, and then you kind of like created two vehicles totaling of like 45 million. And in 2021, you started like an early stage fund. You raised $33 million from 55 to 60 LPs, and you've raised this over Zoom over 3 weeks. And there's like the rolling fund Angeles. Anyway, so I will let you tell the story of what's going
A lot
on.
of stuff.
I'm sorry. I just wanted to, talk about like all your accomplishment before the audience got to know you more throughout our conversation.
Yeah, no, I've been doing a lot of stuff. Yeah.
It's crazy.
That's
I
fun.
wonder, okay, when you're thinking about your own like investing journey, can you talk about like maybe like three big moments of how like that transforming you into who you are today as an investor?
Yeah. I mean, obviously the first big step for me was in 2015 we had an ad tech company that we had been running for about 10 years, and we had made the mistake of partnering with Facebook, and Facebook kind of screwed us over. Not kind of, they totally did. And so we ended up having to sell the business. And so while we were in the process of selling the business, um, one of the companies I've been advising, which is Branch Metrics, I had introduced them to their seed investor, and then NEA had ended up leading the seed, and they reached out and they're like, "Hey, we're going to do a Series A. What do you think?" And I was like, "Yeah, I'd love to try this new AngelList thing and run a syndicate." And so, this was totally on the side, didn't know what I was doing. It was very much sort of like me trying to figure out what to do with my life. Wrote a little memo about why I like the company, and posted it. And 24 hours later, we'd raised like 200K. And I was like, "Whoa, look at me. I'm an investor now." Like, I had no idea what I was doing. But that really started my journey, because it was, exciting and fun. And AngelList very early on, it was a lot of people were very wary of it. So a lot of my peers were like, "No, don't do it. You'll get in trouble. You'll get sued. It's bad." And it was a greenfield opportunity. And it felt like a risk worth taking. So I kind of jumped on board that train, and it's been an amazing journey. And now on that syndicate, and I still use it. It's actually like a superpower for me. There's close to 5,000 people in there, and they're amazing because it's like all these super awesome folks from all different backgrounds who one contribute capital, which is great, but more importantly, every day they send me deal flow, which super duper helpful. Every day, I engage with them. They become friends of mine, and it's like a really powerful community that has formed. They're great at telling me when I'm being stupid. So when I send them a deal that actually they don't like, they'll tell me like, this is a really dumb deal.
Mm.
It's just like this profound community that's formed. And so that first deal really, and AngelList is a community that kind of coalesced around it, is probably by far the most important first step in my journey. It's been, almost 9 years now since, but
Mhm.
that was the beginning. Um, yeah,
Totally. Okay, so hi, Joe. I want to say hi to the audience.
yeah,
Zach is
sure.
awesome. Anyway, so I wanted to ask you about like okay, so there are a couple questions there. Like number one is like when you're like looking back on your journey, I feel like you kind of did a couple things right. You kind of like built this entrepreneur network. So you basically got the deals from the founders because um as you mentioned in another podcast, like if a VC signing a new deal, it must be like they're not so good of a deal. So I wonder when you are like filtering out the founders, like besides like I mean, like we could all like because living in San Francisco, I feel like really privileged to like meet a lot of like very smart people. But I feel like making them a great founder, it's kind of like a really random thing. So like I mean, I personally put tiny check into my friend's company, but like do I expect them to become like Cruz or something? Like I don't know. So I wonder how do you pick the friends who like kind of like you have a relationship with and how do you kind of like maintain the relationship with them?
Yeah. Um, so picking for me is about, I think there's three parts to picking which are important. The first part is like identifying a big market. If they're going to go work on something that doesn't look like it's going to, have real scale behind it, I mean, great. I'm all for that. Like I support them, but like that's not a venture opportunity, and those markets are pretty rare. So like finding that is really challenging. Um, the second thing is stuff that's new. So turns out that a lot of people are doing stuff that's been done before. And if you're not doing something that's really new, what ends up happening is you think about like Bayesian statistics. So like in Bayesian statistics, you have the probability of the event occurring. So it's the probability the founder is going to create a successful company is X. Low to begin with, but like let's hit X. And then the base set, which is all the events that have occurred before it, have a known probability, and like this is what happened in this large number of events that have occurred before it. And so when a founder is going into a space that is new, there's no base set. We don't know anything about
Mhm.
this. Like they've got something that's totally new. It's like de novo, like new, 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 new. So the probability is what's the chance of their success? But when they go into a space that's already well established, or there's a bunch of companies already doing it, we can look at that base set, and that informs the probability of the event occurring. And generally, what ends up happening is that a lot of founders they do stuff that's very derivative, so they're
Mhm.
similar to other things that have come before it, and because they're like, I'm better, which they probably are, but like at the end of the day, being incrementally better, and like humans, if you look at the distribution of human capabilities, it's very rare for someone to be exponentially better than everyone else. They're always just a little bit better than other people. So even though you're incrementally better, it doesn't lead to a gigantic outcome because you take that base set and you basically apply it as the probability of the event occurring, and you realize, well, like, okay, you're like 3% better than everybody else, but the base set, all the other occurrences are relatively small companies. So therefore, you're going to be 3% bigger than a small company. So it's like it just ends up not being all that exciting. And so if you look at companies like that, you're like, okay, is this new? Okay, now we have something that's potentially interesting. But if it's not new, then suddenly it just goes in that bucket of what's the base set. And almost always, in fact, I think in almost every case, the base set means that you're going to end up with a probability of a relatively small outcome. So new. This stuff I
Mhm.
really look for. So big markets, new. And then the third thing is really about like, do the founders actually understand how to build a company? And there's a lot of concepts that like you can go read the books, like you can go read, I mean, lean startups and fourth step to epiphany and um, every startup book you could possibly imagine. Like, and
Mhm.
I've read all of them, right? Because they're amazing repository of knowledge. Startup handbook is a good one. Uh, High growth handbook, Elad's book. There's a difference between knowing it from the book and knowing it from experience. So you read it in the book and then you go experience it and you're like, oh my God. Like for me with my company, um, we started it in 2005. We didn't know what we were doing. And we were like sort of hacking around, like building products, iterating and learning as we went. And we didn't know what we were doing. So like, even though we'd read all the books, we still didn't know what we were doing. And like, it took us years of hard work and just slog to get to $1 million in revenue. And we'd call up a customer and we'd be like, hey, we're amazing. We're better than everyone else. You should use us. And the customer would be like, yeah, call me next month. Like, call me next year. Don't call me again. Like, it was just like, it was so hard. And then when we partnered with Facebook, we figured out, we had figured it out. We'd learned, we'd been in the business for almost 7 years at that point. We knew what we were doing. And we rolled out dynamic creative retargeting on Facebook. That's it. That's the pitch. Dynamic creative retargeting on Facebook. And it was amazing. It worked astoundingly well. The customers loved it. And we'd call up these amazing customers and they would literally, we'd be on a call expecting to like give them the whole deck. And like, they'd be like, so you have dynamic creative retargeting on Facebook? We'd be like, yes. They're like, done, booked, send me the contract. And like, we went from 1 million in revenue to 30 million in revenue in 12 months. And we had 300 million in revenue on the books. Like we were off to the races. So if Facebook hadn't fucked this, we would have been like, oh, such a big company.
Mhm.
Uh, and so in that journey, I had read about product market fit, and there I got to feel it. Like I was like, oh my god, this is the secret. And what I like to say is like startups are in the beginning, it's a journey to find that. It's to find the thing that falls off the shelves that customers just desperately want. And then once you find it, what ends up happening is that the business almost inverts. So in the beginning, the hard part is customers, revenue traction, and everything else is pretty easy. Managing your team, scaling, like servers, like you don't have any problems because you don't have any traction. And then you get traction, and suddenly customers' revenue, easy, everything else becomes hard. So now customers and revenue are basically starting to scale. So you need to scale your team, you need to scale your infrastructure, you need to scale everything. And as soon as you start scaling things start breaking. And people sue you, and your employees turn out to be psychopaths, and all these crazy things occur. And you're like, oh my God. And you get shoved into that whirlwind. But that inflection point, that product market fit inflection point, I had read about it, but until you feel it, you don't know it. So to go back to the entrepreneurs, what I try to do is I try to talk to them about all these concepts that I've experienced both as an entrepreneur and then now that I've worked with a lot of entrepreneurs, like, and try to figure out, do they actually understand what they're doing? And in a lot of cases, they don't, they do, it depends. And so in those cases, then the question becomes like, do I believe this person can grow and learn through this process, or if they already know it, I'm like, here's my money. So like
Mhm.
with Kyle from Cruise, like when Kyle started Cruise, I was like, please, how much money can I give you? Because big market, amazing founder, he knew what he was doing. It's totally new. Oh my God, go. But usually it's not so perfect.
I wonder, I wonder. So you mentioned this. Let's like talk about like the last thing you chat about, like the how does the founder knows how to build a company. I feel like because maybe like I don't know, like so I feel like my friends are still experiencing the first time building a company. So some of them obviously have built like amazing company already, like it become like $1 billion company, but like most of them are like most of the people that I could personally put a check in are like still in their first round of you know funding a startup. So like nobody know what's going on, including myself. I wonder like what's your thought on, like, let's say if a founder with like an amazing technical mode,
Yeah,
but they're like, I mean, I could just tell like they would encounter a lot of like go to market problem. How do you
yeah,
identify who would be able to make it? Like you mentioned, like Kyle
yeah.
from Cruise. Um, like, I don't know his, like, track record before, but, like, it sounds like, he has he's been, like, a proven entrepreneur. But, like, for the people who have not done something significant or, like, haven't
Yeah.
proving themselves, like, how do
Yeah.
you kind of judge if it's a good investment?
Yeah. So there's a lot of VCs who will swear up and down that first time entrepreneurs are the best. Um, so the lack of experience in building a company, I don't think is necessarily uh, a prerequisite, or the experience is not a prerequisite. It's not a disqualifying event if they don't have a lack of experience. Um, if they have a lack of experience, confuse myself. Um, but um, I think it's a couple questions. Um, One, are they good learners? So, and a great way to figure out they're good learners is figure out if they have an intellectual arrogance to them. If they if they think they know everything, like you can pretty quickly find the edges of their knowledge. Like you're like, okay, you're really smart about this, but you clearly don't know anything about this. Do they shift from a mode of knowing what they're talking about to not knowing what they're talking about? And then does their ego then subordinate and do they become curious? So curiosity is fundamentally where ego becomes subordinated to your brain's desire for new knowledge. Some people, they just don't have the ability to do that and make that shift easily, and so and that sort of malleability of their internal mental sort of models, super important if they're going to be a good learner. If they're a good learner, then I can get my head around them learning things to like go to market, them learning things that they don't understand. If they're not a good learner, then no. I'm like, no fucking way.
Mhm.
Then they have to know what they're doing. Like they have to already have the experience, and that's one thing that you look for. Um, Honestly, for me, what I tend to look for is the the um, the market will pull a product out of a company. So if you build a product that everyone loves, everybody wants. So like for instance, I'll give an example. So when Travis first started Uber, he and I were at this party, and they hadn't even launched yet. It was still an idea, and we are sitting there on this balcony, like having beers and arguing about whether or not it would work. Like, and I was like, oh my god, push a button, get a car. I want that so bad. But I was like, look, the taxi lobby is gonna fuck you. They're gonna fuck you. Like you can't win. And he's like, I'm a fighter. I'm gonna win. Um, and uh, and obviously I was very wrong, right? But the other thing, I also taught me a lesson, which is that like when you build something that others like, oh my god, I want that. What I like to say is until you can cold call a customer who you don't know at 9 o'clock at night on her cell phone while she's putting her kid to bed, describe what you do in one sentence, and instead of her saying "fuck you," she's like, "Oh my god, I want that." Like, call me tomorrow. Until you get to that, you don't have product market fit. Once you have that, you have product market fit. If you have product market fit, what you'll find is that the customers will pull the product out of you and they'll pull your go to market motion out of you. They'll just yell and scream until you get it right. And so like for very technical founders, it's the question is like, okay, they don't yet know how to take it to market, but we got to get to that product market fit part, and then everything else will sort of take care of itself. If they don't know how to take it to market and they don't have product market fit yet, generally what I do is I'm like, I'll wait around the rim. I'll try to help out. I'll try to be useful. I'll try to be there, but I'm not going to invest money until they find that motion, because it's like it's very the go to market where you're forcing it down their throat is literally one of the most impossible things in the world. In fact, it's even the best people in the world will generally fail in those scenarios. So I don't like investing in those businesses.
Mm. So, basically, they have to have, like, product market fit before, like, you invest in them, or, like, finding some sort of, like, potential inflection point slash, like, a group of user that would be showing they would be buying them.
Yeah, I think if they're a very technical founder that doesn't have go to market experience, they don't know how to think about it that way, then yes, I would wait for product market fit. Or if it was somebody I knew well and I knew like the thing you think the one way you can think about it is like what I'm trying to do is I'm trying to get confidence in an unknown. So if it's somebody, and it's an entrepreneur I've known for a decade and I've watched them in action, now I know a lot, right? I don't have to ask questions to figure out, are they arrogant, or are they curious, are they good at their job, or like, I know these things. So now once I know it, then I can basically say, okay, if I knew somebody was very technically competent, like I know they are, and I know they're working on a problem that if they succeed, they will achieve product market fit. And I know that if they're working in a market that's big, so it's a big market. That might be something that I would be comfortable investing in pre-product market fit, because I could be like, okay, I'm bearing the risk. The risk is they get a product in the market that has product market fit, but I have knowledge that informs that they're good at their job, and I believe I can underwrite the probability that they will achieve that as being high, because that's my prediction. So then maybe I would invest in somebody in that scenario. Generally, what I find with my friends, like I've been in the Valley for a long time now. A lot of the people I know and I've known for 10 years, everybody else knows for 10 years too. And so it ends up being this like dogfight to get into the round. And like, we're all fighting for allocation, and we're like, please take my money. Because, once you've proven yourself for a long time, you become a known commodity. And so what I ended up finding is that it's difficult for me to deploy as much capital into my friends in those sorts of scenarios as I would like to. So most of my capital ends up coming into people I don't necessarily know quite as well, and it becomes like a slightly different phenomenon where I actually have to suss out, are they good or not. But yeah, it's kind of how I think about the problem.
Totally. Hi, Dave. Hi, Barry. We'll address your questions later on. So, okay. So I think there are like, I really like what you said about, eventually become like, really competitive. You have to fight over to get into a round. But I feel like you have no problem of doing so, because like based on like your Excel sheet, you are investing with like a lot of tier one VC funds or just people in general. And I wonder like um how do you kind of like fight over really competitive deals? And as you mentioned, like you have other smart friends who are like also trying to get into the same thing. How do you build like a advantage for yourself? And I saw like one of the things, like obviously everyone's like coming from LinkedIn right now to watch this live. You obviously have built an amazing LinkedIn following. Does that plays into how it helps you win the deal? And like how do you kind of like curated this community at the beginning? Like the media strategy.
So getting into deals is it. I think what ends up happening oftentimes with a well-known founder is that they decide what they're looking to do. So, like for instance, when Ahmad started Mercury, one of the things that he decided very early on, he had amazing investors. Like A16Z was in there in the very beginning and could have taken the whole round, but Ahmad basically decided that he was going to try to bring as many great entrepreneurs into the community, the investment community for Mercury, as he could, to then help distribute Mercury. So then we would then go to all our founders and be like, "Hey, you got to use Mercury," and that's in those situations, you get there and you're like, "Hey, I want to invest," and he's like, "Okay, you get 200K or whatever I got." So not a big chunk of that round. And so you end up oftentimes you end up just having to fit into whatever formulation that they have for how they do it. And then if it isn't like that and it becomes this competitive situation, what ends up happening is the big VC firms are so desperate to deploy capital that they often deploy the capital of those entrepreneurs at pretty uneconomic prices for the early stage deals. And so then the question is like, do you want to compete with them on price? And you don't want to compete with them on price. You just end up losing money in that scenario. And so you end up just sliding into the round and just like being part of the round, because it's you got a toehold into a good company, but you're not going to go own a big ownership stake. It, sometimes occasionally like becomes a situation where like I want to lead and I'm going to compete and I'm going to like step up, but for me that's pretty rare. For those deals that are well established. Your second question was around LinkedIn. LinkedIn I find is very useful. It's like LinkedIn and Twitter. Like what I try to do is I try to just push as much interesting stuff out into the world as possible. Try to be the content that I would like to read. And then hopefully people find it useful. I don't curate it in a particular sense. Like on LinkedIn, I only connect with people who I've met. That's useful. I try to keep that network somewhat constrained, but it's large. It's very useful for me though. I mean, I use LinkedIn every day, and it's a tremendously powerful tool. Um,
How do
but
you
I
at the
wouldn't say I'm
beginning?
thoughtful about it.
I feel like, I don't know, like, I feel like you are, so, like, I feel like from observing from afar, like, your strategy on media is kind of like, uh, you're, like, on every platform, you are on, like, a lot of people's podcasts, and, um, like, how do you first get, because right now you have, like, over 100K follower on LinkedIn, like, how do you first build this community, though? And then,
Yeah.
what does your graph look like? Is it like this, or is it like a
So
hockey
the
stick?
secret was one of my buddies. He started the LinkedIn influencer program. One of my poker buddies,
Mhm.
and he's awesome. I love him. And he started the LinkedIn influencer program. And at the time, he was like, "Hey, we need somebody who writes about advertising," because at the time my company was an ad tech company. And I was like, "Oh, I can." He's like, "Do I join?" I'm like, "Yeah, of course." I had
Oh
no
my
idea what I
god.
was joining.
What?
It was a new product. It was like nobody knew what it was, and he crushed it. I mean, he went and got Richard Branson and like Desmond Tutu and all these amazing people joined LinkedIn influencer program, and like little old me was in there as this baby entrepreneur who wrote about advertising, and then the algorithm just like took me to the moon. So I mean, I got 100,000 followers like right out of the gate from that, and then um, I've not been diligent about writing long form content and like trying to distribute it and trying to grow it significantly. So it's grown 40%. I think it's like 140 now. So like it's okay, but like it's not something that I've gone and like put my head down on. So uh, yeah, I don't know. I wouldn't say I like to do it in a lazy way. Like all my content creation is like I think about it as like lazy content creation, which is like what are things that I enjoy doing that I would do anyway that would theoretically add some value. So podcasts, this is fun. I like this. Like I'll do this all day long. Um, writing tweets and stuff on LinkedIn, it's easy. I like just stuff comes to the top of my head. I write it up. I throw it out there. But in terms of diligent production, no, I don't. I haven't spent a lot of time doing that.
How do you, like, keep in touch with people, like, the founders in your network? Because I think, like, one is, like, from my observation, I saw on Twitter there's people with, like, 100K follower, but they raised less money than you or, like, other people with, like, 25K follower. So, I wonder, like, how do you target the right people to, like, kind of, like, get onto their radar?
I honestly I don't. So like to keep in touch with people, I do a couple things. Uh, One, I try to go to a lot of events, so like I'm kind of out and about, and that's a good way to kind of keep my
Oh,
network.
you should come to my event tomorrow, but I'll send you a link. But yeah, keep
Okay,
going, sorry.
tomorrow's busy, but maybe we'll see. But yeah, so I got a lot of events. I host every month. I host a dinner. One night we have 45 founders, and then the next night we have 45 investors, and we do that on a monthly basis. So it's like, and it's been going for close to 6 years, and so that sort of like helps kind of if everyone wants to get in touch with me who knows me and is in my network, they can like come to dinner, and it's a good way to catch up. I just try to constantly be exchanging information with people, like and seeing what's going on in the world. Um, yeah, I enjoy learning new things. So Twitter, for instance, is very useful for engaging with folks. Um, LinkedIn, communicating on LinkedIn, useful. I don't know. I just kind of like spam it out there and see what happens.
Um, by the way, like, we met at Charles' event, so I feel like I need to, like, give him a shout out because he, like, literally I was the only unqualified people there, and then all of you guys are really just, like, amazing fund managers. I wonder, for the 45 people founder dinner, like, how do you curate these founders? And then what's your, like, KPI from these? Or, like, is that just, like, keeping just, like, a random, basically like a soft gut check or something? Like, is this, like, making sense? How
Yeah.
what's
No, the
your
list is large. It's just for founders. So you've got to be like you have to have founded something or be have done it before. But otherwise, it's, I think there's like 1,500 people on that list. Um, I don't curate it that hard. It's like, people who I've met who or people that get referred to me that seem like a good fit. And it's interesting. I mean, it's like it's a very diverse community. We get everything from founders of multi-billion-dollar companies will show up to people who are just getting started, and that it's it makes for an interesting sort of conversation at the evenings.
Yeah. When you mention like, so basically, I guess like, how do you leverage your inner circle to like invite people to your dinner? Because when I started this event, like obviously this event right now it's been like really, really oversubscribed because
Cool.
we got featured on Luma. Like I'm thankful for like I feel like Luma make me feel like a Taylor Swift. We have to reject
Yeah,
like maybe like 10 times more than people we can get. But
that's awesome.
like I got really lucky. But on the other hand, like how do you filter like the 1,500 people down to like 45 people?
Yeah.
And how do you kind of like having the most quality people show up at your thing?
Yeah, so that's an art, and I don't claim to be an expert. The way we do it is we just send out the email, and whoever signs up first gets in. So, we just do it on such a regular cadence that it sort of has developed a sort of like natural equilibrium that seems to work. Um, if I was trying to do something highly curated, yeah, that's hard work. I mean, that's like, you're going in, you're spending a lot of time on LinkedIn, you're thinking, you're being thoughtful, you're like, oh, who's what, who's the best, like, and like, I've not tried to put one of those on, mostly because I'm lazy. That's a lot of work, and like, I prefer my strategy generally is sort of like lazy productivity, which is like do a lot of things that are relatively low effort that add value, and then just let the sort of hodgepodge of them come together and equal an outcome that works. Um,
Totally. And when you so like how do you so like you raised $33 million fund in 2021 over 3 weeks. How does that journey look like? And how do you transition yourself from being an angel investor to like getting institutional money?
yeah, so the goodness is that like because literally the bull market in venture was so good that any idiot with a checkbook looked like a genius. Like it was so easy. I mean, literally, I mean it was 50+% IRR every year for 8 years. It was like I invested in 80 something companies during that period and only had two go out of business. Like it was like, I mean, it was the easiest job ever. And so what ended up happening relatively rapidly is uh, capital was not the constraint, allocation was the constraint. So getting access to good companies was the hard part. And so pretty quickly, like if you look at the ramp of my capital deployed, like the first year I deployed about $1 million. So 2015 $1 million, 2016 $3 million, 2017 $14 million. So like, and that was just because as I started learning the job and getting more and more access, the capital also showed up concurrently, and suddenly I had more and more capital to deploy. And so pretty quickly that I sort of hit my asymptote, which is like 15 to $20 million a year for me is like that's where it starts to, for the stage that I invest in, for the check size that I invest in, for the kind of work I'm doing. That's kind of where my current asymptote is. And so then capital became less of a problem. It became the hard part became finding good companies. Like which companies do we want to invest in? And finding them is always a challenge. You have to sort through a lot of stuff to find them. And then so then the type of capital that I use shifted. So originally it was AngelList, and then it became AngelList plus industry ventures, and then it became AngelList plus industry ventures plus some other big LPs. And so then, luckily, at the very top of the market, right before everything crashed, I was like, hey, maybe I should go raise a proper fund and like bring in a bunch of LPs and make this a proper sort of institutional endeavor. And that's the fund I raised in August of 21. And yeah, I know it was so easy because like the track record was amazing. I mean, it was like 50% a year. I mean, it was like look how much of a genius I am. It wasn't that I'm a genius. It's the bull market was so strong. The beta of this business is so strong that like when it's running hot, it's just like go for it. And so it made it very easy to raise that capital.
When you're, I guess, like, so right now, so because I saw that you are investing with a lot of like amazing funds, like, how do you kind of, um, maybe like, let's say like let's say like when you meet a founder, and then how do you distribute them into your network of like other investors? Do you put some money in first and then like letting other like funds getting exposure to this deal, and then, or do you like introduce them to these funds first and then see if they invest in, you would put a small check in?
So one of my strategies that I use is what I call basically doing leveraged favors, which
Mhm.
is uh, in the ecosystem. What I want to try to do is I want to try to be useful to the people in the ecosystem that I respect and that I like and that I think are good. Um, but I want to be useful in leveraged ways, which is like I don't want to like if I spend an hour for you, I save you an hour. I want to be like if I make an introduction, I save you a lot of time and energy to go get that same introduction yourself. Or if I bring you a customer, or if I bring you an insight, or if I do something that like a small amount of my effort is worth a large amount to you. And I want to do that as much as possible all the time. So I'm like, you think about like sprinkling seeds. I want to just run around just throwing seeds everywhere I can. And I don't really think about payback. I don't really think about quid pro quo. I'm just like, whenever I can do that in a leveraged way, and the higher the leverage, the more excited I get, the more I want to do. And I just that's just like my modus operandi, and it's very effective. Um, and one of those favors that's by far the best is capital introductions. Because if I can introduce a good founder to a good investor, they both owe me a favor. Like if the good investor owes me a favor for good deal flow, and the founder owes me a favor for like getting them into a good investor. And so I try to do that all day long, which is like whenever I run into a founder that is smart and capable and seems like they're doing good stuff, I'm like, cool, let me introduce you to a bunch of other investors. And I'll fire hose those out. And so in a lot of cases, what ends up happening is like it's somebody who's doing something I'm not smart in. Like for instance, I'll give you a story. This is a fun story. So very early on in my career, I one of the companies I invested in, the founder called me up. He's like, "Hey, one of the smartest guys at MIT. He's starting a company. Can you talk to him?" I'm like, "Sure." So I get on the phone with him. He's like, "Well, so we're making this device that you retrofit into an airplane that spreads a special electric wave across the skin of the aircraft that prevents ice from forming on the wings of the airplane." And I'm like, oh my God. I don't know anything about aerospace. I don't know anything about special electrical waves. I don't know anything about any of it. I'm like, I don't know, but let me help. So I introduced him to a number of VCs who I know. And one of the VCs was Homebrew. And Homebrew's like, dude, we're going to fund this deal. I'm like, oh, cool. Now, I love Homebrew. Like, Hunter and Satya is super smart. Like, they're if I could just be an LP in their fund and let them do all the work, and I could just go sit at the beach, that would be perfect. So I'm like, sweet, can I invest behind you? And they're like, of course, you introduce the deal to us. So I put in like a couple hundred K into that deal, and it's turned out to be a great outcome. Like that company is just launched with Air Canada. They're putting their solution on airplanes now, and in a few years you'll never have to go through de-ice again, which is a giant business, billions and billions of dollars spent on de-icing, and it's terrible for the environment. You spray all this toxic chemicals everywhere. It's like so it's win-win-win, and purely because I did a favor and I got to ride along in what ended up being a great outcome. And so that for me is like seems like a no-brainer, and I'll do that all day long. And so in other cases, when I find a company that I want to invest in, then this question of like, okay, what's the optimal round to build here, and then who should we get at the table who's really useful? Let's go find some other investors who are really smart because it takes a village to build these companies, and try to be helpful there as well.
I wonder, okay, so I wonder if someone, so basically, what if you introduce them to like a couple investors, like no one bite, and then people think this deal sucks? Or like, let's say the other way is like, some investor invests in them, but like you kind of like didn't really get the memo to be like, hey, Zach, we're investing in X company. Like, basically, they like just like left you behind. Like, how do you deal with these like kind of, I don't know,
Yeah,
things?
yeah. Um, so I'll start with the second one first. Yeah, I mean, look, I always think that when someone does you wrong, they've actually done you a great service because they've informed you that they're a loser, and then you can then like leave. You can extricate them from your life. You can be like, oh, okay, all right, buddy, I'm done. So if that was to occur, like if I was to make an introduction and then they went and did a round and then they didn't tell me, I'd be like, oh, okay, well, you suck. So much for that. Um, uh, in terms of like I generally, what will happen when I meet a company is there's kind of two kinds of companies. There's lots of gray areas, but there's like companies where I'm not smart. So generally, all the really hard technical problems company, I'm not smart. And then I'll make those introductions. I'll be like, hey, here's this company. I'm not smart in this space, but the founder seems smart. Like, I'm not making an endorsement. Like, I'm just saying, here's some deal flow. And and in those cases, like, it's up to the other people to figure out if it's a good deal, and the founder to communicate why it's a good deal. And I'm just trying to do favors. Like, I'm not stressed about the outcome there. In the cases of where I am smart, then okay, now I'm going to do the diligence. I'm going to do the work, and those are usually the rounds where I'll lean in and try to lead, and you know, I'll or because I can't send those deals to people and be like, oh, here's an advertising deal, and by the way, it's a piece of shit. Like, no, I can't do that. So if it's a space that I'm actually smart in, then I'm going to do the work. I'm going to figure out it's a good deal or not, and at that point, I'm going to lead the deal. So yeah, yeah, but I'm not smart in a lot of stuff, so it's easy for me to send out a lot of stuff because I don't know anything about it.
Let's say if you have like 50K, you want to start angel investing from today as like a
Mm.
younger person.
Yeah,
What's your thought process on like spending the money to get into some deals? Like, would you do like the high conviction perspective, or would you try to put like 1K into like 50 deals?
I would try to put 1K to 50 deals. The reason for that is at the beginning of your career, like, so you think about, so the high conviction bet is if you have high conviction, you deploy all your capital into one or two companies because you're expecting to maximize the outcome from that conviction. The conviction leads you to increase the probability of success, and then therefore, if you put all your capital into the place with the highest probability of success, then you'll be in the position to make the most money. But
Mm,
if you're early in your career, the goal is not to make money. The goal is to learn. Because if you
mm,
think about, if your career, you really are become successful as an investor, your career, you will be deploying tens of millions or even billions of dollars eventually in your career. And so the more you learn today, the value will accrue over the lifetime of your invested capital, whereas the value of the dollar will simply just accrue over the lifetime of that investment. And so, like,
mm,
everything that you can learn, every time you can trade, basically making a little more money for learning more, you should do that. Like,
mm,
one of the luckiest things that happened to me very early on is that I kind of had to go like run around finding deals, and I had to go do a lot of deals because I didn't have the capital to make conviction bets. And what I did have was AngelList backers who would come into deals with me if there was a strong VC lead. So like when NEA was leading around, or Sequoia was leading around, or Andreessen was leading around, they're like, well, there's that guy, we don't know about him, but we know this is Andreessen, so we're going to invest in the deal. And so, in those deals, you can't get a large allocation because Andreessen's already taken up all the allocation. There's like a little bit for you. And so, like, when I had little bits of these companies that I went and like hustled up, and the best thing about that was that it gave me the learnings from each of those investments. So then I got to watch the entrepreneur, I got to watch the company, I got to watch all the funding. I got to learn by being an insider in all these different companies. And so, like, compared to most VCs who kind of go out, or early stage, or not early stage, but early in their career VCs who, they get a VC job, you become principal, you start deploying capital, you have to live by the VC's structure, which is we make high conviction, large capital bets, because that is how you get the biggest outcomes. And they get like two or three shots on goal, and then those don't work out, and they get fired. And it's like, that sucks. Like, whereas I got 80 shots on goal, and like, yeah, a bunch of them didn't work out, but like a bunch of them did, and I got to learn from that. And so now I'm a much better investor as a result of that learning. As opposed to if I had only had 8 shots on goal, I wouldn't have learned nearly as much. And so I think that's the right way to do it. It's go learn. The goal is to learn as much as possible. That means get access to as many. Now, you don't want to just go write a check into a company where you don't get any access, because you don't learn anything from that. Like, I guess you get to learn to see what the outcome is, but like, you really want to have a company where you have access to the entrepreneur, where you can like be helpful to them. They use you, you get to be in the flow, and then you get to learn. So write as many of those checks as you can, and then go learn as much as you can.
I wonder when let's say you invest in a company with a tiny check, how do you kind of add value? So basically, I wonder, like, let's say if I get asked a lot, like, "Hey, can you like put us on your podcast?" Blah blah blah. Like, I wonder, like, how do you like scale your helpfulness, and like how, like, I guess, like, how much effort do you spend on each founder, and then how much introduction you would make, because I feel like if you're making like, let's say you invest in 50 company, and then they're like really varies, right? Like there must be like, let's say 90, like 40, 90% company that like just went into a complete shit show mode at one point. And the 10% company maybe like racing the next round, doing something else. But like on the other hand, if you're like introducing like 5 investor for each company, you're like your full job is like sitting there like making
Yeah.
intros, and the investors who are getting like 50 deals from you will be like literally block you on day
Yeah.
3.
Yeah.
So how do you kind of do this thing at scale?
Yeah. So part of my job is to be a filter. And so, you know, if a company's not doing well, regardless if I've invested in it or not, I'm not going to be fire hosing introductions. I'm going to be fire hosing feedback. I'm like, here's what you're not doing right. Fix that. Um, and generally, what I find is that the companies who are not doing well because the founders aren't good listeners. They're not good at taking feedback, and they generally don't like to hear it. And so when I tell them you're fucking that up, stop doing that, they stop calling me, and then problem solves itself. Like, and whatever. I can't solve their problems for them, and they don't want to listen. So say lovey. Um, uh, the 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 good companies, everybody wants to get those intros. So my job is to find them. Now, sometimes they're in spaces where I'm like, I don't know, but it seems okay. And then I default to like, let's send it out to half a dozen people. And then like, if those people love it, then I send it out to more people. And if those people, if it's crickets, then I'm like, well, it was crickets. Bummer. Um, like I kind of let the market solve for that problem in the situations where I don't have an informed opinion if it's a good company or not.
If you're more in like a earlier stage of your career, would you ask for like, would you go for like the scout route, or like you would go for the syndication route? Meaning like, let's say a lot of like the angel trying to start a fund, they go for like scouting for other funds, right? Like, so basically they send like all of their deal flow to like some of these like big funds. And
Yeah.
if you're going that route, how would you go about it? Because if you're just sending it to one person, like, you kind of like also wasted the seal flow, as like if they don't invest, like nobody else will be hearing about it, and like you're like, this cannot be like a leverage for you, right? And how
Yeah.
would you go about that route? And then on the other hand, if you're going the syndication route, like you like what you did, right? Like, I mean, not everyone who can do what you did, like, which is like, you're a really seasoned founder who have like, you can like raise like 200K over 24 hours, but most of us have to like really hustle to get like literally DM like, I don't know, 7,000 people on Twitter to be like, hey, do you want to invest in my friend's company? And then how do you even get the conviction to do the really crazy shit, like literally DMing everybody for this one deal?
Yeah.
How
Yeah. Yeah.
would you approach
So
these two things?
I'll work backwards on this one. Uh, I think the secret to AngelList is that um, the backers don't really know, nor do they really care who the lead is. Like, even I've been doing this for a long time. Like, there's some people who invest because it's me doing the deal, but what they care about is who's the VC firm, not even the partner. They don't really know who the partners are, although that's really the secret.
Mhm.
Who's the VC firm who's leading the round? And so if it's Sequoia, Andreessen, and Yang, Greylock, all these big firms, um, then the capital flows rapidly. It's easy. So if you can get access to deals that have high quality VC leads, you should run syndicates, because what you end up getting is a lot of capital very, very rapidly. If you don't have that, then a scout fund is great, because now you basically have a fund where you can go put capital to work without having that signal that is coming from the market that tells you this VC thinks this is a great company. Um, uh, Oftentimes what happens is that you meet a company and they don't have a great VC lead, and in those cases, what I like to do is I like to go help them find a VC lead. That's a great leverage favor. I'm helping them. I'm helping the VCs. Everybody's happy with that. And so that in the beginning, that's what I would do all the time. I would find these companies. They seemed really good, and I'd send them out to my network. And I'd be like, "Hey, this company looks really cool." At the end of the day, VCs don't like. They don't mind more deal flow. Like you can be really curated about it, but like I think that overthinks it. I think like as long as you do a level of curation where this person is competent, this market is big, this is an interesting thing. They're happy to get it generally. And so that's what I do is I just try to send it around to a bunch of people. And then if a VC emerges like that, like the DS deal with Homebrew, then boom, I get to put a check in. And that was my strategy. And I liked it. It worked for me. But but the more important thing, everyone's got to figure out the right strategy for them, which is like, where's your deal flow come from? How much do you have? What do your relationship with VCs look like? Like what do you have that enables the flywheel to spin? And then what do you do to support the flywheel spinning, as opposed to coming in and saying, I'm just going to invent this all from scratch? Because that takes a long time. You kind of got to work with what you already have.
I wonder, like, I have two questions around that, and then we can like maybe address some audience questions. So I want to ask, like, how do you find that VC lead? Because does that mean like you have to literally like going to lunch with Sequoia partners every week, or like how do you actually make that
No,
happen?
no, no. I just send them emails. Like, they get an email, they look at it, they decide if they want to do it or not. You just have to, a lot of VCs and you send a lot of deals around. No, like we love deal flow. All VCs love deal flow. So the more you send, the better. As long as it's not shit, like send it on through. Like you literally could send me 100 decks a day and I would be happy. My eyes
Okay,
would
I guess
bleed by
I
the end of it,
agree.
but like, I'd read it. But I go through it really fast. Like, cause it's like, is it new? No. There's so many things that are not new. Okay. Is the market big? No. Okay. Like, boom, now it's like a much smaller pile. And then like you go from there.
But, like, I mean, what is new, right? Like, I mean, like, I literally, like, I talk about, like, one of the company that I thought was really interesting to a VC fund. Like, they basically said, like, "Oh, this thing it is new because, like, it's, like, in the AI sector," and then one of the audience questions about AI, like, I'm definitely curious your thought about AI. But anyway, so it's, like, AI is helping, like, basically, like, this company's leveraging AI to do something that, like, have never been done before, but on the other hand, they have, like, maybe 6 competitors, and some of the big company maybe just, like, straight up copying, sort of, like, remind me of your company got copied by, like, Facebook, right? So, like, I guess
Yeah.
the general thought is, like, okay, is this, like, completely new? It's not
It sounds
cruise
not new.
new. Yeah, it's
Yeah.
also not new.
So then at that point, like the company has to demonstrate. What I like to say is that ideas are worthless. Validated ideas are priceless. So demonstrate, de-risk that what you're doing is going to generate a delta, an advantage over the alternatives in the market. So demonstrate that there's something about what you're doing that will lead you to being preferenced by customers. And the question is like, what is that? How do they do it? So now we're getting into the real part of the job, which is like, you can say all these nice and easy things. Is it new? And then what does that actually mean? And then the reality is, it's like there's a lot to figure out. Like, how is it new? Is it actually new? Does it have an advantage? And like, yeah, I could spend hours talking about this, but you're generally trying to figure out, do they have a significant advantage in the market that's relatively difficult for a competitive company to replicate in short order, and can they actually make that? So, for instance, if somebody comes in like, "Hey, I invented a battery that lasts 1,000 miles," oh my god, like prove it, right? Because if you had that, like every fucking auto company in the world would give you billions of dollars, but now you got to prove it. Uh, so when somebody comes to me, they're like, "Hey, I got this company that like makes everyone's life better." I'm like, "Prove it." And that's our part. But yeah,
Um, okay, so I wanna address, like, 2 of the audience question. One of them
sure.
is, um, all else being equal, how heavily would you weight the difference between second-time founder, one whose first effort succeed and one who's did not?
Yeah. So uh, second time founders whose efforts didn't succeed are great, right? They learned a lot in the process. The question still remains: Are they working on something new? Are they humble about understanding what they don't know and learning about that? All the things that you try to figure out with humans. Like, it's like dating. You're like, is this person smart? Is this person thoughtful? Is this for high EQ, high IQ? Like, you try to figure all that stuff out. But like, yeah, I invest in second time founders all the time who had a bad first outcome because they some other investor got to pay to teach them a bunch of lessons, which was very helpful.
The other question is any AI opportunities that you are excited about in any vertical and thoughts?
Yeah. New. So there's a lot of stuff in the AI space. It's like there's like 20 companies all chasing it. I'm looking for people who have new ideas. They're like, here's how this amazing technology enables us to do something completely different. And it changes the business model, it changes the go-to-market, changes everything about. And that's what I get most excited about. If you're gonna be one more company that does AI for X, then it really becomes who's the founder that is doing it, and do I believe that that founder has the ability to achieve a great outcome. And that's that's variable. It depends on the founder.
I don't know how much time you have. I'm trying to keep this question short.
Okay.
So okay, so I have a friend or like I okay, so let's say it this way. It's not like a friend. A lot of friends are like, looking at all the YC companies, right? Like, and then people rank them in different like category of things or like, how likely they will succeed. Like, what do you think is the best strategy of the approach? Should you just like go ahead and talk to every single company and then kind of come up with a thesis, or like you kind of judge like, okay, there are like five company I want to talk to, and like let's pick one from like one of my like just significant research from these
Yeah, the
companies.
hardest thing about YC is that so when you go to demo day, you look around. There's 1,000 brilliant people in the room. Like my peers, my competitors, like and the question you first have to ask yourself is, am I the smartest person in the room about this? Um, and For me anyway, the answer is almost always no. Like it's like no, I'm not. Like okay, biofuels, no. Dev tools, no. Solar, no. Crypto, no. Because there's people in the room in those particular answers I know are like fucking geniuses in that subject, and I'm like, oh, so I'm not the smartest person in the room. So so that's how I filter. I just start with that, which is like, am I the smartest person in the room about X? So generally, that list of things that I'm the smartest person in the room about, it's like very small. So I start with those, and then I dig through those. The challenge is oftentimes with YC is that because it's this somewhat curated pool, a lot of investors who are just looking for sort of index access to the asset class will come in and they'll plow money into stuff. And so even the companies where I am the smartest person in the room, like oftentimes will be overpriced because people who don't know, who are not smart, are throwing money in this company because it's in YC and they're like, I'm getting the index. And so, like, finding the diamonds in the rough that is both an amazing company and basically I know what I'm doing better than anyone else in the room is pretty rare. So for me, YC at demo day tends to be very difficult to invest in. I do a lot of deals before demo day and a lot of deals after demo day, and I love YC. Like they're amazing community, and like it's a superpower to be part of YC. Like I recommend every founder should take a hard look at them. But for me as an investor, demo day it can be challenging. But I'm there. I love it. So yeah. But I don't the systematic YC investors. There's some people who've done like for instance, one of my friends, Alan Rutledge, amazing investor. He's like and he is like one of the best YC whisperers I know. I mean, he's got that thing wired. Um, and yeah, so that's like a whole different skill set. There's people who are experts at that, and that's not me. So good luck to Alan. Get Alan to give you advice on how to do that.
Okay, awesome. I will stalk him. But anyway, so what's your I have like a 30-second fire round for you. Um what's your content diet look like?
My what?
Content diet.
Oh, I don't know. A lot of Twitter, a lot of LinkedIn. Um, I just read the internet all day long. Tech meme, love tech meme. Uh, yeah, just read a lot of content, and yeah, I don't use TikTok. I try to avoid stuff. I have pretty good ADD, so I try to avoid stuff that's toxic for ADD. Though Twitter is toxic, but it's also Twitter. Um, but yeah, I try to read as much as I can. A lot of books. Um, a lot of books.
What's your favorite book?
Oh, I can't say I have a favorite book. I love biographies of business biographies. Like yeah, if it's a biography written about a business or a founder, I'd like to have it on my shelf and read it.
Amazing. What's your unfair advantage?
I like I like networking. I enjoy it. It gives me pleasure.
Who would you invite to your dinner party?
Um, I mean, It's a good question. There's so many smart people that I'd want to meet. I once got to meet Desmond Tutu, and like the guy was like unbelievable, and I was like, whoa. So I'd love to spend more time with him. He would be cool. I've never met Barack Obama. I'd like to meet him. Uh, I obviously would have loved to meet. I got everybody. Like, give me all the smart people. Like, can't stop.
Where can we find you outside of work?
So I ski a lot in the winter. I kiteboard in the summer, like every other douchebag VC like me. I travel a lot, trying to go to every country. Yeah, just try to have fun.
Amazing. Thank you so much, Zach, for coming to Venture with Grace today.
Yeah, thank you. I really enjoyed it, and keep up the good work.
Thank you. Oh my God. I'm ending this.